Today, we're going to start our July fundraising workshop. I'm super excited to kick this off. We're actually doing this as a national effort now. So we're going to be broadcasting this to all our SVB clients as well as founders in our ecosystem. Yeah, let's get going here. All right, so a little bit about SVB. We sit in between founders and investors. We've been the innovation bank of choice for about 40 years. We're now under the strength and stability of First Citizens. So when we're talking about innovation banking, it's really about like how can we as a technology bank support early stage founders and investors from idea on a napkin sketch to IPO and beyond. And we do that through a couple ways, through basic banking as well as venture debt. And we also have members of our private bank here too, to really help kind of think through the end-to-end founder journey of like, as you start a company, what does each milestone mean and how do you tap into the larger SVB ecosystem of other operators, founders, entrepreneurs, and investors. A little bit about myself. My name is Bo Wren. I'm the managing director of startup banking here. I've been at the bank for about 3 years. Started my career out in the operating world as a product manager, building early stage consumer social at Meta, Instagram, and Tumblr. Moved out here to New York to start product advising a lot of early stage companies and made my way into the world of venture investing at Samsung's Innovation Fund in AI, edge computing, data privacy. And now I get to work with the best in class founders in New York and nationally, within the SVB ecosystem. I really enjoy, kind of putting on an operating partner hat to support our portfolio of founders with company building, fundraising strategies, and just really being a helpful nexus to like the larger SVB network here. So today we are joined by two fundraising guest speakers. So this is a really cool pilot that we're doing. Today we're having Hayley here, who is a partner at First Round. She's also a founder, operator, angel, and prior to First Round, she started Birchbox, which, by the way, was my dream job in my 20s. I didn't apply, but this is a lesson that you should always apply to your dream job in your 20s. But when I was a baby product manager, I was like, I want to move to New York and work at Birchbox, but this has come full circle.
We had collaborated.
I know, but it's not too late. So yeah, Hayley has worked at Bain and Company, Christie's, Amazon in strategy and product management. She's also the founding member of All Raise, which is an organization advancing women, founders, and investors. So we're going to get a lot of, background and best practices from your amazing operating background and track record. And we're also joined by Rob Broderick, who's a partner at Wilson Sonsini, and he practices corporate and securities law. We don't usually have lawyers join us, but Rob is a cool lawyer, and he is a strategic advisor first to founders. Yeah, like Rob is a great person to really talk about anything around private financing. If you are closing a round and you want to talk through all the term sheet, logistics, negotiating. So yeah, just quick disclaimer about fundraising. We're going to talk about state of the market data from our market insights team from 2022 to 2024, but know that like a lot of the advice and the guidance we're giving needs to be custom tailored to your own sector, your own, market and geo-specific fundraising tactics. So let's lay the scene for where fundraising is today and kind of, the macro market here. Obviously, 2021, was kind of the peak. Everything was at a bull market. Now, in the last 2 years, we started kind of going through what, economists would be calling like quantitative easing, and just like things have just been not as great as things were before. And it feels kind of weird, to be honest, because it's like consumer sentiment is high. No, consumer sentiment is low, but the labor market is strong. So where we kind of sit today is in between like the two previous crises that came. So the great financial crisis, 2008, and the dot-com. The dot-com took a lot longer to recover. So what recovery looks like for us is going to be somewhere in between the great financial crisis and the dot-com. And we're really seeing recovery happen still quite slowly. We'll kind of dive more into the private market, but as the kind of IPO market continues to be locked up, markets are not clearing, which takes a long time for, liquidity to trickle down. So just kind of setting the scene for where we're going today. I think despite, the macro markets still being not rosy, like we're still seeing seed valuation and deal size like remain quite robust. So the median, seed from 2023 was 2.7 million. It grew to 3 million. The other growth stage, fundraising events like have definitely dampened since 2021. So Series A's, B's, and C's have struggled a little bit more, but we are seeing recovery even in the growth stage in 2024. I think what's interesting is like the chart at the bottom, which shows what recovery looks like in terms of valuation and how, quickly these early stage rounds are bouncing back in valuation compared to the later stage. So we're actually seeing the later stage here like recover faster than the seed stage valuations. But also just as a caveat, like our market insights team does have lagging data with seed. The data pool is a little bit more fickle than growth stage. But yeah, would love to kind of get your thoughts, Hayley, in terms of like year over year growth in pre-money valuation since 2021, which was the peak of the market.
Yeah. I think what we're seeing on the ground definitely matches this data. I mean, 2020 and 2021, it was bananas. That's a technical term in terms of the amount of capital going out, the valuations. It was real peak. The adjustment happened middle of 2022. And we've seen a recovery, but I think it's really a story of a bifurcated market, and that the recovery has been specifically towards certain sectors and certain profiles of companies.
Right.
I think as I look at this data, the thing that I would remind people is that the data on round sizes and valuations is only for the rounds that are getting done. And so you're seeing a growth in the round sizes and the valuations, but there's a lot of rounds that just aren't happening where the market isn't clearing. And I think that's sort of what's not shown on the chart here.
Yeah, there's like definitely survivorship bias here of like these are the rounds that are getting done. And I think like this is where the conversation can be really interesting to kind of talk about down rounds too. I'm curious, like, as a startup lawyer, are you seeing more down rounds happening, or are deals coming to you that are more seed extensions in the last couple of years?
One way to avoid the down round, as you mentioned, is an extension of your prior valuation. And oftentimes that's an existing investor that's willing to step up to the plate and say, well, effectively bridge the company to the next round by investing at the same price without going out to market, which may not bear a flat or higher valuation from the last round. I think one thing that's a little bit unique about this market downturn, so to speak, is that companies reacted to it very quickly. So there's a lot of mid and late stage companies that raised a lot of money in the frothy market and then were able to cut burn very effectively pretty quickly. So you have companies with an insane amount of runway that will have to raise eventually, but not in the near term. And so to Hayley's point, the data may show one trend, but I think there's a lot of companies that haven't had the other shoe drop yet. They're going to raise enough for 2 or 3 years. They may or may not have real businesses that can clear the valuation they raised at in say 2020 or 2021.
Yeah.
But we'll see.
Yeah. Right. So obviously when we're talking about the larger macro picture, we can't avoid the AI boom that's going on here. And we did a recent Empire State of AI report talking about in specifically like what types of AI companies are being built here in New York. And I thought what was interesting is that the data we analyzed showed like, yes, the AI companies are benefiting from the current AI boom with inflated valuations, but then post seed, like the growth stage, they're also correcting like the rest of the market. So like I think what's interesting, especially as a generalist investor, Hayley, is like everyone is now an AI company. Every fund is now an AI fund. So like how are you teasing through all the deal flow and seeing like what is a real, like long lasting AI driven company versus someone who's just retrofitting AI as a feature set?
Yeah, so we invest primarily at the seed stage. So we're a generalist funds leading seed rounds that range from 2 million to 6 million in size. And I think this chart on the left-hand side is interesting because it stops in 2023. I think if you were to plot what % of deals at the seed stage are AI related in some way this year, it would be double what you see in 2023. It is just fundamentally an exciting platform shift that has gotten a lot of really high quality founders excited to build companies leveraging this new technology. That said, the way that we evaluate AI businesses, it's not that different than how we evaluated businesses for the last 19 years that we were doing seed investing.
Right.
It comes back to founder, market, products, like the fundamentals of the business. So we're not sort of like turning things upside down or evaluating things in a different way, but we are just excited about the founder quality and the potential for real disruptive new businesses that are being started in 2024, most of which are leveraging AI in some way.
Yeah. And we'll kind of dive into specifically like the first round approach to AI as well.
There is a question in the chat here,
Yeah.
if that's okay.
Yeah, let's
So from the audience here, so do you think that the VC world is currently far too overstretched, meaning they manage far too many assets? So from this person's research is about 1.2 trillion, then the exit market can absorb. So that's like the first.
the private market's too bloated
Yeah.
for the public market to absorb.
Yeah. That's the first part of the question.
I think the asset class is changing. You see funds like Andreessen, they don't look a whole lot like what a venture fund looked like 10 years ago. They have a buyout
You're
fund.
basically a hedge fund now.
Yeah,
Yeah,
they've got a
PE firm.
buyout fund now, which, maybe answers some of that concern, right? There's going to be companies that are going to be, selling and not going the traditional IPO route or selling to a big tech company. So you have funds like Andreessen who are, addressing that kind of need for the market. But the asset class has changed dramatically over the last several years. I think we'll continue to do so. And funds like the companies they invest in will continue to innovate. But part of that is also the capital markets have been largely closed, for some years now, and everyone's kind of holding their breath and hoping they reopen. And on top of that, there's also a squeeze from the M&A side of things because you're just not getting regulatory approval for M&A deals. And so the path to liquidity for a startup is maybe more blurry now than it has been in years past. But time will tell if those things kind of reopen and if there's other exit opportunities or paths of liquidity that don't exist at scale today.
Yeah, I think the way we think about it is, yes, for sure, there's more capital in the asset class, which means that things are being priced more efficiently. Like that's why you see the trend line in seed deals in size and valuation going up. There's more capital availability. That will impact sort of what the funds are able to do in terms of if exits stay the same, but your entry price is going up, then your returns go down. But at the same time, I think there are always cycles. We just came out of a cycle where there was a lot of liquidity created at very high multiples. The IPO market was open. When we invest today in a seed company, we don't really care about the exit market today for those companies. We have to wait for the cycle to be at its next peak. And this is like an 8 to 10 year game. So you can't force exits like at a consistent rate every year. You sort of have to believe in the founders, the big markets, and then you have to wait to time the exit markets to get the returns that our LPs seek.
I guess one common question we get often from founders is like these funds were raising so much capital during the peak of COVID, and a lot of them were deploying at like astronomical valuations in like the peak of 2021. So are there existing venture funds that may have over allocated their dry powder during the peak of the market and are now, kind of starting to pull back and like say they're currently active, but actually may
I
not
think
be
we do
as
that, actually.
we
I
are?
think it was like
Okay.
2022 and 2023. People were like, oh, wow, that was crazy. Let us
Right.
like take a beat. Let us figure out how things are going to price.
Yeah.
And so you saw sort of like venture funding go
Yeah.
down pretty precipitously.
Yeah.
But I think like people are back at it.
Okay.
And I think that is very much AI
Yes.
driven. And
Yeah.
there's a lot of optimism
Yeah.
about that platform shift.
Yeah.
Yeah,
I
and I
mean,
think you continue to see, like, if you look at announcements for these multi-stage firms, they are continuing to raise multi-billion-dollar
Yeah.
funds.
yeah.
And there's maybe some firms that are right-sizing their funds, raising a little less, but overall, I think for sort of like the big name top tier funds,
Yeah.
it's pretty much business as usual in terms of fund
Yeah.
size.
In terms of like what Bo was saying, are VCs concerned on like the pressure that LPs put for return on their investments through the venture fund?
I mean, of
Are you guys
course.
getting pushed, I guess?
No, I mean, I think so first round's been around for 20 years. We have a very strong track record. Our LPs have a long-term orientation. And so no one's pushing for distributions today. I think they want to see consistency and an eye towards creating liquidity over time, but we don't feel overt pressure on a short-term time frame.
So zooming more into like New York AI activity, we're seeing that even though, 2023 and 2022, like the New York VC activity fell by 38%, the AI deals that were being done still had held steady, and we saw a pretty healthy deal size grow in AI from 2022 to 2023. So this really supports like everything he's talking about is just like AI, is the Cambrian explosion that's happening, but also the question here is also like how are we going to see these exits happen, right? If so many AI companies are dependent on like Microsoft and OpenAI and Nvidia, like is there going to be like a lot of consolidation? Like where is the actual like value chain going to be delivered? Is it the startups or is it like these large FANG
I mean,
companies?
I think this is always a question for any technology shift is like,
Yeah.
where does the value accrue? Does it accrue
Totally.
to the incumbents that have the data, have the distribution, or is there an opening for new entrants
Yep.
to be able to create massive value?
Yeah.
And I think what you see here is a lot of VCs and founders are betting that some of the new entrants will become generational companies.
Right.
And the pricing reflects that.
Yeah. Are you at first round like thinking about valuation in AI as like this is going to correct at some point, or is it more like there are certain deals that are just inherently hot and you have to be competitive and meet
I think it's
those?
honestly more the latter.
Okay.
I think it is very dangerous as a VC to be a value shopper
Mhm.
and to say, oh, I'm going to not invest in the most exciting ideas or the most exciting founders because it's priced 30% higher than my average deal.
Yeah.
I think you have to be willing to stretch. And that's what we've been doing when it makes sense.
Mhm.
At the same time, I think, we're probably not alone in saying, okay, we don't want all of our investments to be high priced deals like this. What
Sure.
can we do to meet founders earlier? What can we do to understand them and de-risk maybe getting involved at the pre-seed
Mhm.
stage instead of the seed so that
Right.
our average entry price is more consistent to what we've seen in the past.
Yeah. That makes a lot of
But I love to
sense.
see the New York data here. And I think
Yeah.
New York has definitely benefited from the AI wave. Like there's a lot of talk about what's going on in San Francisco with AI, but I think, there's a lot of great talent in New York as well, and specifically in AI applications.
Yes, so you literally predicted this next slide, which is, let's talk about AI applications in New York. So I think anecdotally, like we've been hearing Cerebral Valley, Bay Area is like the home of the picks and shovels of AI, all the foundation models. But in New York, we're seeing, this like kind of diversity and like interdisciplinary approach to AI, which I think is uniquely New York. It really hybridizes like all these different industries. So when we ran the data on like types of AI companies across the tech stack, we found New York had a percentage of vertical applications, and SF, had more AI model development, foundation models, the OpenAIs, the Anthropics of the world. And then, the world you can kind of interpret like it's more into like chip manufacturing and, compute. So definitely, I feel like Rob and I have been tweeting a lot about New York AI and why this is going to be, we're championing it as the AI capital, but we're also seeing a lot of promise here because like, I feel like New York is just such a hub when it comes to like proximity to Fortune 500s. Like this is the highest volume Fortune 500. So if you're an AI company, you want to be selling to CISOs and, CIOs, like this is the market for you. So yeah, I'm curious, like Hayley, when you're thinking about like first round in New York, like how are you guys seeing and characterizing the New York market compared to the Bay Area?
I mean, one thing that I've seen over the last 4 years is that geography is just a lot more fluid.
Yeah.
You're seeing talent move from SF to New York and then back again, or some sticking in New York, especially young founders. They're sort of like choosing where they want to build their company based on the lifestyle that they could have while they're building.
Yeah.
And a lot of them are running fully remote teams.
Yep.
So, I think geography as a sort of like sorting criteria for us at first round as a bi-coastal firm, it's less relevant than it was pre-COVID.
Yep.
But I'm not surprised by this. I think in general, New York founders tend to really think about like real world applications. They tend to have commercial instincts and a real business model up front. I think that's just sort of like in the water in New York. I also think New York benefits from like the East Coast educational institutions, because a lot of the cutting edge AI is being done out of places like MIT, or when you think about robotics and AI, Carnegie Mellon, and then those ecosystems kind of like decant into New York. So we benefit from that as well.
Yeah, great. And then when we're talking about kind of the zooming out, like the larger kind of seed to Series A trajectory, these are a lot of charts, but I think like the takeaway here is a lot of the large mega seed funds continue to be deploying capital and, propping up a lot of these valuations. And I think to answer the question from our audience of like, what is the evolution of, this asset class? Like we're seeing a lot of multi-stage funds where like the Cotus, we haven't, heard of some of them for a while, but like they're coming back. And also we're seeing mega seed funds like the debut, the Greylocks of the world. And I'm curious to see like as a smaller, more boutique seed fund compared to like a Tiger Global, for example, like how have
call them a seed fund.
Oh, yes, but they're also competing in seed, and it was super intense, especially in 2022 and 2021.
Like 5 markets lumped into one bucket.
Yeah.
Like seed has really been atomized.
Yeah.
First round, our name is first round. You would think that we're doing the first round, but actually we lead seed rounds. But sometimes those founders have raised a friends and family round, an angel round, a pre-seed round from institutional pre-seed
Mhm.
funds, maybe a first seed, and then we're investing in a $6 million second seed. So there's just like a lot of different dynamics
Yeah.
in this bucket.
Yeah.
The larger your fund is, though,
Hmm.
like a multi-stage fund with multi-billion dollars under assets, the more that you could treat a seed round like a loss leader or a feeder into the rest of the funds. And
Right.
so multi-stage continues to be active at seed. When they're active, they're less price sensitive. And so that's where we do see these bigger rounds that are higher priced. There's usually a multi-stage firm
Hmm.
impacting that dynamic. But we actually fall on the upper end of this chart. So first rounds, our fund size is above 400 million, which is larger for a
Mhm.
seed fund.
Yeah.
Our median seed deal that we participate in is in the like $4 to $5 million range.
Okay.
So that's very different than like there is a lot of seed funds that are operating with less than $100 million in assets, and they
Right.
might be more interested in those pre-seed rounds or a smaller seed round just because of like the economics of how their fund works.
Yeah.
And I think this is a good thing for founders to be aware of when you're fundraising, to think about, okay, this VC, the seed funds that I'm talking to, what is the average round size that they participate in? Are they doing more pre-seed? Are they doing smaller seeds? Are they doing larger seeds? Like, make sure that what they've been active in matches the type of rounds that you're seeking.
Yeah, I think you want to be careful as a founder also, and this isn't true of every investor at every multi-stage fund, but you don't want to be a call option for a multi-stage fund. They might just be trying to get a toehold into the company. And then, if you don't prove out, maybe they don't follow on, which is a pretty negative signal to the rest of the market, right? If Tiger invests in your seed, or a fund like Tiger invests in your seed, and they're not willing to lead the next round, despite obviously being capable, and that's kind of what their fund structure is, that tells the rest of the market, hey, what do they know that we don't know?
Right.
They don't want to double
That's a
down.
negative signal.
That's
Yeah.
a negative signal. And it's one of many reasons not to necessarily optimize for price. You want to partner with the investor that understands your business, that you connect with well, that you think is going to add a lot of value, roll up their sleeves and work with you, and not necessarily, the fund that's going to put the highest price on the business or have the most logos on their website, whatever it is. There's a lot of other things you need to solve for, including terms, and I think maybe most importantly, the relationship and how you fit into the incentive structure for the investor.
Yeah, I think that's a great call out, because a lot of, like founders have come to us being like, I just need the biggest valuation, I just need the biggest check. But like at the end of the day, if your investor is not able to help you when, push comes to shove, like this, it's, money is cheap, but like the expertise that you're getting from like a Hayley who's like actually built real companies, and our operators, like obviously I'm biased as a former operator. I think like, having the operating chops like does help the types of companies who are struggling today in the trenches, and being able to call on your lead investor and your board for like crisis management, versus if you are thinking of yourself as like one in a couple hundred in an index fund for a mega seed fund, like what is the incentive for them to really help you out when you're struggling, versus waiting for a significant part of these bets to die off and then doubling down on the ones who are winning. So definitely I think there's
It's like an ad
nuance.
for seed specific funds.
Yeah, yeah, exactly. Yes, Simon, go ahead.
Quick question. What are your thoughts on solo GPs? Like, does it like, I mean, just curious your thoughts, like, does it like provide like negative signaling to like larger funds like first round?
I mean, I think, it depends on the context, right? There's a lot of different solo GPs out there. I think many solo GPs have big personal brands, and they're quite good at generating like heat behind a company. If what you're looking for from an investor is like hands-on support, I think just like the dynamics of how many investments is that one person making, and therefore how much time do they have for each of their investments after they fund, like they're going to have less time than a fund that maybe has invested in multiple partners, a platform team. So I think it's a trade-off, but there's a lot of great solo GPs that we like to work with, and I think there's a lot of great solo GPs that have really created an edge, especially in terms of publicity for the companies that they invest in.
And for founders who are like looking for true like first check writers, like do you recommend certain types of, you know, funds versus others, like in terms of size, AUM under management, the types of, you know,
It's a
solo
good
GP
question.
versus multiple GPs?
So I think there's a lot of different entry points for founders into the seed market. So we often are leading rounds where we're literally the first check in, but it's a $5 million round.
Right.
That's different than someone that's looking for their first 500K just to get started and to de-risk some things. So I think you have to look at the size of the rounds that the fund has or person has participated in, and think about what you're raising and what's the fit there.
Got it. Great. So let's kind of talk more about the elephant in the room, which is down rounds have become more prevalent, especially, you know, also just a caveat, a lot of this data is underreported because people are not going to TechCrunch to announce that they have raised a down round. So please, like, just think about this, you know, with a grain of salt. But like, we do see that more and more rounds getting done, especially in 2023, are, you know, the percentage of down rounds have increased. We're also seeing that, like, despite down rounds, you know, there is a silver lining, like these companies are still getting subsequent fundraising, you know, so like a down round is also not the end of the world when you're in a bear market. I feel like this is more a question for you, Rob, since you're probably in the, you know, legal, like, re-architecting cap table world. Like, how are you advising founders to think about down rounds, you know, from a structure perspective, but also just from like a longevity, staying alive, thinking about, you know, what is good for the company long term so that they're set up for success if they do have to take a down round?
Yeah, I think there's two things I would call out just about how the down round functions and why it's such a, you know, taboo term, why founders want to stay away from it all the time. The first is that trajectory is just so important for companies. So anytime that you've fallen off the path of up and to the right, just raises serious questions about the business. That's obviously something you want to avoid. From a more technical kind of legal standpoint, it's highly dilutive to the founder and the existing investors, because when you have a down round, if you have, you know, preferred stock that was issued at a higher price, they're entitled to additional shares of common stock. They don't get more shares of their preferred stock. There's a liquidation preference, but they effectively own a larger percentage of the fully diluted business as a result of this anti-dilution protection, which is in your legal documents. So founders want to stay away from it. There are ways to kind of sidestep a down round, so to speak. We touched on this earlier in the session. You'll see investors step to the plate and do an extension of the last round. You might do an extension of the last round, but give the investors upside in the form of warrants. They just get more shares for effectively free in the upside scenario while maintaining a per share price that's equal to the last round. So you technically haven't done a down round, but, you know, effectively you really have without advertising it. And there are other ways that are kind of more punitive to the existing cap table. You can convert preferred stockholders to common. Sometimes you need their consent to do that. Sometimes you don't. That's kind of more nuanced discussion. But if the decision for the founder is, you know, raising a down round versus giving what we would call structure to the investors, things like a multiple on their liquidation preference, or they're controlling the business at the stockholder or board level, we would generally advise the founders to kind of swallow the medicine and do the down round as opposed to putting structure in place, because once you have these kind of exotic terms that can really warp the cap table and warp the governance structure of the company, you're probably going to live with those forever. They're very difficult to get out, and they create a lot of misaligned incentive structures where the outcome for the investors is much, much different than the outcome for the founders in various scenarios.
Yes, I agree. I think it's hard when a down round is necessary, but in some ways it could be healthy to reset the price. You know, I think the mantra that we use with our portfolio, if this is something that they have to go through, is like, honestly, what matters is not the in-between valuations, it's the exit valuation. And if by taking a down round, you get fully capitalized to like live to fight another day, like that is always preferable than trying to optimize just for price. and when a down round is necessary, there's also ways to make sure that the founders and the team are sort of right-sized in terms of whether it's the price of their options or the shares that they own, because I think everybody on the cap table always wants to make sure that the people who are running the business have the right incentives in place to make it a success.
There's a retention concern, I guess I didn't raise, that's related to the point Hayley just made. Just when employees get stock options, they get them at fair market value, and they find out what the fair market value is, so that's their strike price for their option. If you're gonna get a new 498 valuation, new fair market value assessment of the common stock after the down round, that price is gonna go down. And so word gets out pretty quickly at a company that if the down round wasn't announced publicly, that, hey, something's up because my stock that I thought was worth X is now on my options underwater. It's not worth anything.
Yeah.
So that's some messaging that, founders need to, handle internally, because, morale and retention are so important. You can do things to mitigate that. You can reprice underwater options, for example. You kind of give the employees the benefit of the lower strike price. There's some nuance with that, but it's doable. But that's just another kind of consideration, another reason why down rounds have some, effects that founders want to avoid.
The other thing that we talk about with our founders is the great examples of truly iconic companies that did have to suffer down rounds along the way. One that comes to mind is DoorDash, which had a pretty epic IPO in the last couple of years. And I'm pretty sure Facebook
yeah.
went through it as well. So I think like when founders have to go through it, it's nice for them to know that they're in a neighborhood of some founders that really pulled through and created a lot of value. Sometimes you just sort of have to take your medicine along the way.
Yeah. And to your point, like in the longer, grander scheme of your company, like a down round is maybe like, survival is paramount to growth. The whole point is just to stay alive as long as possible. And like, if you zoom out on a big enough timeline, the trajectory of a company, like you hopefully is so good, you don't have to think about the down round that you took.
Exactly.
Yeah.
First, excuse me, for some of the clients that I support, some of them actually go on to raise more than they were actually hoping for, or there's just more interest than they were expecting. And so then the price goes up as well. Is there, like, should they be thinking about in the future how that could affect them later on in later rounds if they go to raise again and maybe it's a down round? If they're not maybe like tracking to the right milestones or something like that. Is that something that
Yeah, absolutely.
you guys would?
Valuations come with hooks. Like if there's an expectation for the next round to be, a markup of a certain return for the early stage investor, that means you've got to hit certain metrics in the next round. And it may be premature for a business to do that. And so, like I said earlier, trajectory is super important. And if you can, you'd much rather be, up and to the right, albeit at a lesser slope, than shoot up really high in valuation, come back down, and now you're in kind of murkier water.
Right. All right. So let's dive more into the first round world. So would love to kind of, think about, Hayley, like how you guys are thinking through your thesis, your focus areas, verticals, and, really like this forum is for our founders to really think about and understand like what first round is looking for when they're pitching to you guys.
Great. Happy to do that. Yeah, so we are called first round for a reason. And that is because we are a stage specific fund. So we invest in B2B, B2C, hardware, software, AI, not AI. The thing that really connects everything that we invest in is the stage of the business. And the value that we bring to the table is the things that any business at that stage of pre-product market fit, of having unique insights, but maybe some early customers, but really having to do the things like hire your first team, figure out how to price and package your product, figure out what your go-to-market motion is. That's where we really help provide advice, connections, insights, and resources. So let's see what's on the next slide. I talked about this a little bit before. I think founders don't often think about the business model behind the investors that you're talking to. And so I laid it out pretty clearly for us. Like, what do we do? What we do is we lead seed rounds. Those seed rounds can be smaller. They could be a $3 million round, or they could be bigger. They could be a $7 million round. and we write the lead check. So that's usually half or more than half of the rounds. And what we look to do is own 12 to 15% of the business. A typical seed round, the total dilution is usually for the founder 20 to 25%. So like you'll have a first round involved taking 12 to 15%, and maybe you'll have another, maybe a sector specific fund or a group of angels that fill out the rest of the cap table for that round. And then it's hard to see in the colors that this ended up, but we at first round have a second round guarantee in that we lead your seed rounds and we always take pro rata in an outside led subsequent round, usually the Series A.
Can you define pro rata?
Yeah, so pro rata is usually institutional investors have pro rata rights, which means that we get to write a check that maintains our ownership percentage in the business. The lawyer could probably do a better definition of
That was
pro
great.
rata.
I couldn't have said it better myself.
Good. And so, I mean, Rob talked about signaling risk, right? What if you take money from a very big fund that it was a call option for them, and that partner leaves, they decide they change their minds about how interested they are in the sector. They have $1 billion under management, but for some reason they're not participating in your next round. That can really put sort of like a stink over your next fundraise. And that's the reason that, first of all, we're stage specific. We'll never lead your next round, but we will always participate so that every company in the first round portfolio can start their fundraise saying, we're backed by first round, and first round is taking their pro rata in this round. So this is probably doesn't look like rocket science to you, but this is the checklist that we go through when we're evaluating seed stage investments. These are the main buckets that we're evaluating. And I kind of put them in order here, where the most important thing in an early stage business is by far the founding team. Often when we're investing, I think it's about 60% of the time, it is pre-traction. 50% of the time, it's pre-product as well. And so really we're evaluating people and their insights and their match to the opportunity. And I think your job as founders is to tell the story about why you. What makes you and your founding team members the absolute best people in the universe to build this company. Then the next thing on the list is market. We have a business model which requires that we return a certain amount of capital to our LPs. And that means that we need home runs, not base hits. And so that means that we're looking for businesses in large enough markets with good margin dynamics and competitive dynamics to be able to create outcomes like Uber, which we were the first investors in, like Square, which we were seed investors in, like Roblox, which actually had a bigger IPO than Uber did. We are aiming for those really big markets that have the right fundamentals. And so we're often thinking just about the market dynamics when a founder's pitching us. We also look at product. But honestly, we invest so early that either the product doesn't exist or we know that it's really going to change. Often when we look at product, it's just a reflection of the founder. And we ask things like, why did you make this choice? Or why did you decide to start here instead of there? And that helps us understand how the founder is going to continue to iterate the product in the search for product market fit. Terms is last. We'll never not invest because of terms. But it is a factor. So that's our rough framework. Over what we're aiming for in terms of home runs, this is just a slide that shows what that means to us. The first is we believe really generational enduring companies over time develop defensibility in the form of a wide moat. That doesn't mean that there needs to be a moat day one, but that if you're able to get to scale, whether it's through network effects, whether it's through IP, you create defensibility that allows your business to really compound. Second is the economic engine. So we're seed investors. We aren't asking for your historical financials really, but we are going to ask you questions about what are your margins? What's your CAC to LTV? You know, this isn't just about investing in businesses that could create top line revenue, but businesses that can create a real strong economic engine. Founders, management team. And then we think about sort of like, it is easier to become a big business if your business is really retentive, and your customers love you. And this applies regardless of sector. If you've built a business that has a leaky funnel where you are constantly having to reacquire users, if your net revenue retention is low, it just makes it harder to become one of those home run businesses. And so we think about those dynamics, even at the seed stage. And then addressable market. Sometimes, when we invested in Uber, the TAM for the black car market was small. But what we believed when we wrote that check was that with amazing technology, it could grow the market. So the large TAM doesn't always have to be today, but the founder has to make a case for why there could be a large TAM if they're successful over time.
On number 4, which is like high customer satisfaction, how do you recommend founders convey that like NPS, that like customer obsession when they're so early?
I think honestly, that's one of the most important things you could do, even if you don't have like month over month revenue growth or any revenue at all. If you are able to communicate that your customers or your potential customers love you and what you're building, that's really important at the seed stage. Ways to communicate it. Customer quotes, having referenceable customers. So we are often getting on the phone and talking to your customers directly. Sometimes founders record testimonials. For a consumer business, sometimes that's done through surveys. For a consumer business that is live and has customers, we'll see that show up in terms of whether it's you measure NPS every month, or you could show us what the sort of like the referral factor is. That you can be creative in how you get that across.
Great.
So Bo and I were talking yesterday, and she was like, what sectors are you investing in these days? What's your thesis? I think we are very interested in great founders in big markets, regardless of where we are in the cycle. But this is what we're seeing in the market, especially in the Series A, is that after the market corrected, there was sort of a bifurcation in terms of the sectors that the overall market is focused on. And there's nothing scientific behind this. This is sort of like rough, but there's markets that are hot and there's markets that are not. And the 3 at the top, anything infrastructure, security, you might have seen the news about Wiz and the potential 20 billion plus acquisition by Google. 4 years after that company was founded, like the security market is going to continue to be super hot. And then, there's a few sectors that have just become really, really challenged, where there's headwinds, where there's an adjustment post-COVID, and that includes some of the ones that we've put here. But for us, we're still investing in some of those sectors because we think things could change. If you're a founder in one of these sectors, there's often sector-specific funds that they have raised capital to deploy in that sector, and they will write checks. So this isn't like your round won't happen if you're at the bottom of the thermometer. It just means that you've got to be a little bit more creative.
For founders who are, say, building in the consumer side and, they're a C. All right. So we are at time, but we're going to just kind of skip through some of these slides. I want to kind of go through the sales funnel of fundraising, because I think this is where a lot of the nuance happens in terms of qualifying your investors, like you mentioned, and thinking about getting those first intros and really iterating through time and creating a sales funnel. I'm curious in terms of, when you're thinking about getting intros from other investors versus founders, like, do you have any, higher signal ways of reaching you versus lower signal ways.
Yeah, I think I'm probably not the first to say this, but like we love getting referrals from our founders. I think hearing from operators, especially ones that we've invested in, is we're like very likely to be excited about talking to the talented founders, talented friends. And a lot of the deals that we invested come from upstream investors. So that's angels, pre-seed funds. So ideally those folks are already on your cap table or they've committed to the round and they're making an intro. But honestly, whatever way you could make an authentic connection to a VC is game. And a lot of it is just like a numbers game. So, you know, when you're making your CRM, like, of course, you're going to have your top 10. But in today's market, you should probably have 30 on that list.
Yeah.
And
And also stack rank them too in
Mm.
order of priority of
Mhm.
like who is safer to practice your pitch on early on. Like
Mm.
an angel, you know, someone who is a mentor could be a better person to like practice your pitch, iterate through time, and then maybe save Hayley for once you've got it.
But don't say
hyped.
it till the end, because maybe you're gonna like get a term sheet before then. So
Yes, save her for like halfway through, maybe.
yeah,
You know?
one or two
Yeah,
get good, and then
there you go.
you know,
Yeah.
you can chat.
Yeah. Great. And then in terms of qualifying investors, I think we've touched upon a lot of that. I think the more nuanced variables I would love, you know, both your thoughts on are like the vintage of the fund and oftentimes, you know, the activity, because these aren't clear, like people aren't announcing, hey, I'm XYZ fund, I've deployed 90% of my dry powder. You know, how do you recommend the founders who are currently fundraising, you know, think through the things that maybe aren't actively, you know, on PitchBook and may require a little bit more sleuthing?
I mean, I think a quick Google and Crunchbase, you could see if a fund has done anything in the last 3 to 6 months. And I think that's probably enough of a sniff test. And yeah, I think most fundraisers are announced in like is it Axios or a term sheet? And so you could see, okay, when did the fund last raise? And as long as it's in the last 2 to 3 years, that firm should still be deploying capital.
And then in terms of check size, like I think this is the part where like a lot of founders, I think, will attribute like a firm of like, oh, I'm raising, you know, a seed plus, but then they're talking to someone super early. Like for check size, I think this is the part where we oftentimes see a lot of founders like mistake going to growth stage, you know, or multi-stage firms even when they're raising super early. So I think it's important to really do your homework and really think about looking at past, you know, investor history of like what are the types of deals that they've done and have they even invested in a competitor who's building in the same category as you. I think oftentimes like founders think, oh, because you did studs, are you going to do something, or you know, you did Ando, are you going to do something in that space again, right?
Box last week,
Right.
where I like passed out a company and they came back, but they're like, but you've invested in these 2 companies that are both adjacent to what we're doing. And I understand why the founder thought, like, don't you want a third? But we're a generalist fund. We place bets across lots of different sectors. And sometimes, like, first, we don't want 2 companies that are compete with each other, but also we need to diversify.
Yeah.
Yeah.
Yeah, I think that's a really important nuance because oftentimes like investors are making a bet in a specific category, but that doesn't mean like they want to put all their eggs in one basket, right? So like for you, it's like you made a bet in like those 2 companies and maybe like your
It might be
thinking
different for
have
sector specific funds.
Sure.
Like they might
That's a
really
good
like
point.
have a thesis and they want to invest in everything that's like, yeah, future of transportation or something.
Yeah.
But for us at least, you know, chances that we'll invest in 2 things within a short time period that are in the like same subsector is low.
For companies that have gone through accelerator programs, does it make it more or less interesting to you as an investor at the early stage?
It's a good question.
I think we like to evaluate the company standalone. I think there's maybe some accelerator programs that are a positive signal, like we're very active in the last YC batch. But for others, I think, we're just looking at founder, market, products. That's it. Yeah.
Great. I think we've kind of touched upon what a lead investor looks like here. But I think that the part that oftentimes like founders are seeking for, like this is like the kind of like Moby Dick moment for them of like, I got it, is like when they land the lead investor and it's kind of like that's the transformative tipping point. But it's so hard until you get to that point
Oh,
because
yeah.
it's, oftentimes like people are asking you like, do you have a lead investor? Do you have a lead term sheet yet? I would love to invest once you have a lead. So,
I remember when I was fundraising,
yeah,
like the
it's
seed
almost like
rounds
a
that I
catch
raised for
22.
my company, it was amazing how like the conversations just shifted as soon as we had a lead investor. And it went from us like really having to sell it to, it was almost like we had to push people away.
Mm,
Once they're,
wow.
I mean, our
Yeah,
lead was first rounds.
sure.
Right now
Sure.
and that's a very strong signal, but
Yeah.
it was crazy. It's like, and I agree with this graph, like 95% of investors, they're kind of like sheep. They just want to follow people who have made that hard decision to take that leap of faith. But I think, there's ways to help create that tipping point, not just with a lead. I
Mhm.
think sometimes getting commitments from smaller funds or from angels or just creating momentum in your business is another way to create this sort of feeling that like the train is leaving the station. Like, are you in or are you out? A lead investor certainly helps, but there's other ways to create that feeling.
Do you recommend investor updates? Like people who may have passed on you, are you keeping them, updated of like, hey,
I love
we have
investor
these?
updates because you should be leveraging your investors and
Sure.
updating them, using them as a fundraising tool.
Yeah.
Yeah, sometimes, I think the likelihood that you take someone from a pass to a yes, I think is quite low.
Mhm.
But something that could be helpful is if you have existing investors, you're writing investor updates and then you forward it to a fresh contact. Like sometimes when people are pitching me, they're like, oh, I don't have a pitch deck yet, or I'm working on my deck, but I'm going to forward you the investor update that I said, talking about, what happened through June. And I actually love getting that view of a company because usually there's like some real honesty in there in terms of like KPIs compared to plan, there's highlights and lowlights. And so I think it's like kind of a power move to use your investor updates for your existing investors as part of your pitch materials for new investors.
Mhm. Yeah. I like that idea of like you're kind of meeting them at the messy middle. Like I may have a shape-shifting product, but let me like keep you posted of how this idea evolves because I've seen pitch decks like in the span of 6 months be like completely different and
Yeah.
like change investors' minds too. So just because you're getting passes and no's doesn't mean, you won't be hitting that fulcrum point. And then angels we've also talked about, but I think angels, having angel invested myself, and I know you were an active angel too, or still angel investing, like this is, I think, like one of the most kind of underrated ways of getting traction and tapping into a larger network of other lead investors. There's often communities coming out of these liquidity events from companies that create angel groups, and you're able to share your deal flow with, hashtag angels, which came out of a group of women who were at Twitter early on, backbone angels from Shopify. And I think like these are small checks, but they have really high human capital associated with them, especially if you're building in a space that the angel investor has worked in. They're able to kind of be early champions and open doors for you. How are you thinking about angels on the cap table? Like, is that like having a really hot angel early on, is that a positive signal, or, is that just kind of more of like adding to the hype of a round?
Um, we love having angels on the cap table with us. I think angels who are active operators can just be like so helpful to a founder. And especially angels that serve a specific purpose, whether it's because of their functional expertise or their experience as a founder before. In terms of the signal for a fundraise, yeah, I think it could definitely help.
Mm-hmm.
I think if stack ranking the sort of referrals that we get, founders, angels, right there.
Mm-hmm.
But it needs to be an angel that like is truly excited and has an authentic reason for investing. I think if there's someone who is sort of like spraying and praying and writing lots of small checks and maybe can't even speak to the rationale for their investment, that matters less.
Yeah. And it sounds like angels are also a source of deal flow for you too.
For sure.
Like folks who have written checks. Great. So we've kind of gone through that. In terms of prepping your pitch deck, I think we've kind of talked about the first round method, but are there like certain pitch deck follies maybe, Rob, you've seen too? Like what are mistakes to not, repeat that you recommend first time founders at the seed stage think through?
Yeah, I think in the first pitch deck, a lot of detail can show thoughtfulness about the business, but you should also be able to articulate value proposition pretty clearly and concisely at a conceptual level. And data can support that, but I think you need to be able to tell the story first and foremost. And also really early, you should be highlighting why you or your founding team is best situated to solve that problem. Because the investing thesis early, as Hayley has mentioned, is as much about the people as everything else. The other factors matter, of course, but you're really investing in people, and why are you the person that's going to solve this problem? I think is super important. So highlighting those things in the deck, I think, are critical. I wouldn't highlight like an advisor roster. You see that a lot.
Yeah.
That's largely meaningless outside of really specific situations, like maybe there's some like regulatory connection that you have, or you're selling into some very hard to break into market where an advisor who's actually incentivized to help could be useful. I think that's the exception, not the norm. People like to throw names and advisors on deck because they think that lends them credibility, but
All the logos.
yeah, it can have the opposite effect. It can show your focus on the wrong thing.
Great. And then in terms of thinking about, this arduous process of getting to the lead investor, like we've oftentimes like advised companies, to really think about like when you get passes, like how are you getting information or feedback that is going to help you iterate. So it's like you really just need that one hell yes, but that might be 20 no's leading up to it. So this is a common like line our founders hear a lot, is just you're too early. How do you recommend folks like, there's oftentimes one approach of like, let me drill down and understand exactly why you passed, and then there's also like the other approach of like, I'm just going to like talk to the people who are going to be like, the goalkeepers instead of gatekeepers. So I'm curious, like every VC has a different take on how far you push to get to the reason why someone passed on you. Like, how do you recommend founders process the no's?
I mean, I think it is best practice for us as investors to try to give you some critical, constructive feedback, but you don't always get that. I think you get sort of like one bite at the apple in terms of like, tell me more. But like trying to go back for a second or a third or disagreeing, I don't think it's in your favor. Another place to get insights to test, learn, and improve is to keep track of the questions that you're getting during a pitch. Because I actually think that there's more signal in the questions that were asked than in the pass email. And try to understand if there's trends. Like, ooh, a lot of people are asking about market dynamics, or a lot of people are asking like where our technical leader is. So questions instead of, trying to get too much out of a pass.
I think this also goes back to like the neuroplasticity of like learning to pitch too. It's like oftentimes we've seen founders like they'll in an intro call, if it's 30 minutes, they like open up their entire pitch deck and slide by slide, they're going through like this 20, slide pitch deck. And it's like sometimes a VC just like wants to be able to like shoot the shit and talk about a certain space and like think about how you're thinking on it versus like going through your entire pitch. Like do you have any recommendations for like founders when you are light pitching versus doing a formal pitch, like how to read the room? Because like investors are always assessing you if it's like in a coffee chat.
Totally. I mean, I think every founder probably has a format where they perform their best. I personally, as a founder, loved using slides because I'm a very visual person. I liked having that.
That's the Bane coming out of you.
Yeah. And it's a visual product also. And so that's the format where I did my best. But I would try to err towards that. But you definitely have to figure out your customer, the VC, and be like, hey, is it all right if I pull up some slides? And if they're like, no, let's just make it conversational, then like bend and weave and like try to hit the format that like they want. Don't be like, I'm gonna pull up the slides anyway. So you got to be comfortable with a few different ways of doing it. Or like you start with a conversational and then like you try again a few minutes later and be like, I've got a great like graph to show you on this, and like try to like screen share for a little bit and then see if you could keep going.
There is
yeah,
like an art to
every investor has a
storytelling here.
different style.
Yeah. Yes.
Does first round tend to meet founders in person or more remote? Like what is or your preference, or just first round in general?
So 2024, I'd say, I don't know, maybe 30% of first meetings are in person. I think that is really founder preference because it is more efficient to take first meetings over Zoom. In 2024, we always meet a founder before we issue a term sheet though. So even if the first meeting isn't in person, we're gonna meet that founder at some point during the diligence process. And I think that's because it's an important signal for us, but also because it increases our ability to create a relationship and win that deal if we want to invest. And that does mean that we have to like hop on planes and, make it work.
That's why you're bi-coastal.
Yeah.
Great. So we are finishing up now, but I wanted to also kind of give you a snippet into how to better work with SVB too. So a lot of what we do is, these fundraising workshops are really a forum, safe space for founders to come and ask questions to the best GPs and now lawyers, so you're setting the bar for all lawyers to follow. But also we love to work with founders as clients too. So we have piloted a new product called Nexus, which is a new investor connectivity tool for our founders who are SVB banking clients. And it is a way for us to really think about, I'm happy to always make intros to other investors if, I'm convicted in a company, but this allows us to tap into the larger SVB network of like our investor coverage teams who are banking the first rounds of the world, the Lairs, the, Sequoias, like are able to really think about how to artfully route these intros and make it bespoke and at scale too. So this is a preview into, how to work with us as a client. And, we're more than happy to be a resource here, and feel free to, respond to our follow-up emails and ask for more information down the line. So thank you guys for joining us, and thank you, Rob and Hayley, for like all the insights and, advice. What is the best way for folks to get in touch with you guys, I guess?
I'm Hayley at First Round, and you can spell it however you want. And it will still go to
Wow.
because it's misspelled so often.
All the permutations.
That is our Broderick at WSGR.com.
Great. Awesome. Well, thanks so much, guys.
Thanks, everyone.